Very good morning, friends. Today we are going to talk about which is the best time frame to trade and which are the best moving averages to use. Now, these are the two common questions on a very simplistic level I get asked quite often. A lot of people come and ask me, so which time frame should I watch the chart in? Which one do you think is the best time frame? At the same time, there are a lot of people who ask me, so which time frame is the most optimal to trade, which is the most beneficial to trade? Now, the whole idea is that if I have to summarize which is the most beneficial time frame to watch a chart in or to trade, right? And at the same time, a lot of people ask me, which is the best moving average, sir? Which is the moving average which will work out the best for me? And if I have to actually summarize all these time frame related queries, which are very common, lurk in the investor's mind, traders' mind, very commonly, I'll have to conclude several answers that would be lying on immaterial grounds of technical analysis. Yes, actually, there is no perfect time frame and there is no perfect moving average of a particular time period. What exists when somebody asks me, so which is the best time frame to trade? What exists as a truth is which time frame is the best for which trader. There may be a trader who is an intraday trader. So an intraday trader would like to take up time frames that are considerably shorter term. He is more into intraday. He wants to have a difference of time between him taking a trade and that trade working out for him very small. But to be an intraday trader, you need to have the correct skill sets of using chart based approach in a more accurate way. You see, as you will go down and down to the time frames, the charts tend to become more and more noisy. So the smaller the time frame is, the higher is the skill required to from a technical point of view. So somebody who is comfortable with the smaller time frames it can be a trader that who will be trading intraday. Someone who is not so comfortable with the small time frame but is extremely comfortable with a time frame of a few days in hand should be the right person to be trading short-term positions on positional basis. And then somebody who is not wanting to give the time to even worry about how the market is performing, wants to look and monitor his trades at a big time interval, and perhaps someone who has a lower risk appetite also, those are the traders who will be looking for swing trading that can go weeks and weeks altogether. So which time frame is the best for which person really matters. Now you see, when somebody is coming and asking me this question, the person should talk about his personality also. The person should talk about his personality also. It is not easy to just go and take up any form of trading. You need to try something on your own. You should need to try something by yourself first, and only then will you be able to understand which suits you better. Now, which suits you better does not really depend on how you would make money in the first few days of trading. It really depends on how much time you give to check your consistency. So, for example, if you want to try how intraday trading is suiting you, it will of course take you a few days, because in a few days you will see a lot of market scenarios that over the different stocks and indices and other currencies and commodities, all asset classes. In a shorter time frame, you will see different phases, and you will be able to decipher how the intraday movement really happens. But then, if you are going to try out something like swing trading, then you have to understand this. that only to even develop the correct swing trading patterns, the correct weekly chart patterns, it takes more time. The bigger the time frame, the bigger time, the longer it takes for the strategy to develop the opportunities to come. So you cannot be in a hurry in trying those things. Now, coming to the second question, a lot of people ask me, what about moving averages? ये सब तो ठीक है. What about moving averages? Which is the best suited moving average for trading and chart reading? Now, therein lies an important answer to this question. That yes, there are no perfect moving average, but for different stocks and for different periods of time, different moving averages really help. So let's consider, for example, we are going to take up a few moving averages, and in the process of taking up those few moving averages, we are going to also see how the various moving averages are working out. So first, I'm going to plot on my screen is the moving average of uh, 20 period, and let's color it green. It's totally green. Yeah. So we just plotted a 20 period moving average. Okay. And now let's plot an average of 60 period. Now, what is the purpose of 60 period? Please understand that moving averages have some essence and some logic to it. Moving averages, what they principally are about, it also have to do with the kind of time which generally goes with people holding on to trades, right? So 20 days stand for 20 working days in the market in a time period of 1 month. 60 days stands for 60 working days in the market in a time period of a quarter of an year. So we have 1 quarter of an year, which would be 60 days. So we have taken up, and we can take up 200-day moving average. So let's take up 200-day moving average. A lot of people have heard of it and must be there, who come to me and ask me about, sir, this is an excellent thing to follow, which they are not wrong in. So 200 moving average, which we can say stands for a period of time that is comprising of 200 days of trading. So it's almost an year's average. Okay. Now moving averages are plotted on the closing basis. Okay. Now, as we move on, as we put the moving averages, you can understand that the differences between these moving averages are very subtle. So, just to show you from a point of view, again, how we started the whole scenario. Let's start with a smaller moving average. I'll hide the rest of the moving average. Now you can see on the screen how the moving average is closely following the price movement. If the price movement is being closely followed by the moving average, right? You can see how beautifully it is following the price movement. It is almost acting as a very important point when the price movement is there. Now, a lot of people want to take cues from this, that price movement is going to be supported or resisted by moving average points. It is not always so. Okay, and the short-term moving averages always do not give you a signal, but the short-term moving averages are very, very, very important, very, very, very important in gauging two things. One is for a particular phase of the market, what would be the moving average which would act as a support or resistance. So in this question, in the chart over here in question, which is the Nifty chart, we can clearly see that the average, which is the 20 moving average, is actually acting like an extremely good support area. So I like to call it dynamic trend line. I like to call it a trend line that keeps moving in time. So this area, okay, we can decipher as something where the importance of this particular moving average is coming about pretty nicely. You see, it is really acting as a support line. a dynamic support line, and eventually when the support line is breaking, there is a correction also that follows, right? So a dynamic moving average of the 20 moving average is very important in this case. Now I happen to take up another stock, and I happen to understand that the moving average on the basis of technical analysis also the moving average on the basis of 20 tape moving average, 20 period moving average also was very crucial in that stock. Then I took up another stock, and in that particular stock and some other period of moving average was actually more important. So you see, this is going to be an ongoing scenario all the time when you have a look at the moving averages. So there will be these various stocks which will display the importance of one moving average over another in a certain market phase, and if that certain market phase is taken care of, okay, with that moving average, you can sensibly have some reliance on that moving average for that market period. Like for example, let me take up the chart of Infosys, right? Now, two things to be noticed over here, guys. I'm going to say something really new. Many of you mustn't have heard of this before. Moving averages do not have to be necessarily made on the price movement of the closing, the average of closing. Not necessary that the moving average should be from the closing prices. Moving averages can also come from the prices that are comprising of all days low. So an average of, instead of average of price close, instead of the average of price close, I'm making the average of price low. And now you can see the average of price low in case of Infosys for the current market phase as it is going becomes a very, very important place for Infosys. So average of price low can be extremely important as a point. So guys, see how the Infosys stock is not being able to penetrate below the average of low prices. Okay, so this is something which you can take away from. So in this particular time frame of trading, okay, in this particular time frame of trading, which is the daily chart, and time frame of looking at the chart, knowing which average is going to play out is the best case scenario over here. So something new for a lot of people, they mustn't have heard for it before of it before. Now if I go back to the Nifty chart and I look at the same moving average, which is the average of the lows, it is not working out so well. So there is a different case scenario, and as soon as I change it back to the price close average, you see how beautifully it is showing me that in a certain market phase it is coming and taking rest on this average. So these are subtle things to be noted, that a difference in the parameters can change and do have a different meaning for different stocks in different times. Now coming back to the idea of average and plotting the second average over here, which was the 60-day I had plotted earlier. So 60-day plotting we'll do again now. And if the 60-day average is taken in question, then we see something different. So first of all, 60 days is a bigger time period than the 20-day. So the fluctuation is less. It is slower. The fluctuation is less. And just like in 20 days, the short-term highs and lows were coming around the 20-day moving average. In this case, the medium term highs and lows come around the 60-day moving average. For the time being, once I will hide this so that you can only look at the 60, and you can see how the medium term important interaction points and inflections happen through this moving average, right? Now, one thing to be noted, moving averages are not only, and in most cases, they are not supposed to be for supports and resistances. I mean, do you think you can take up any moving average and it should act like support and resistance? No. Then how would the true meaning come out of a particular moving average? Okay. Now, what happens is when you have such a scenario, okay, where you are seeing on a recurring note that a particular moving average is allowing you allowing you the luxury of look at this area, look at this area, look at these areas. The interaction points are so clearly mentioned over here, so clearly important over here, right? And when these interaction points, when these things come together, right, we can understand that at some level the moving average does have some importance. And this importance comes out from two things. One, yes, of course, is the nature of support resistance, and the second is the nature of volatility. That means that if the price comes and hovers near the moving average, if the price comes and hovers near the moving average or hovers near the moving average, it is telling me that the price is shrinking in volatility. Now, whenever in the price there is a shrink in the volatility, after the shrink in the volatility, there are periods of expansion in the volatility. So, moving average can be useful in this case. We can see how during the times when it comes and hovers, it wants to come close to the moving average as well as go away from the moving average. So it is wanting to get close to the moving average as well as go away from the moving average. So this is something which I will take as really, really important. Now let's mix up the two. Let's mix up the two moving average we saw till now. Right, and I'm using just this one chart to explain you better. I could go to all stocks, etc., but the whole point is to explain you in a manner you understand the core of it. And I, of course, on YouTube, I cannot go as deep or give so many examples as I give to my students in the course. But yes, of course, there are a lot of things you will be able to take up from if you watch this video for once or twice, and then when you're going to go back to a chart and study it, you can use these parameters to understand how things are to be highlighted. Right now, if you look at the 20 and the 60 period moving averages, so what I want to point out over here that when we have two time frames, you have to understand the market is moving in different time frames, right? There are endless streams of movement in different time frames. So first thing first, we need to absorb the fact that in the different time frame, uh, different moving averages will be apt. So I'm looking at the short term, something like a 20-day moving average is apt, or a 10-day moving average is apt, right? So I've been talking about this as a 10-day moving average. I'm extremely sorry if I spelled out. So 1 second. I'm going to just change this. So the previous one I had drawn was 20. This is 10. Okay. Okay. So in case of a 10-day moving average, we saw it coming very, very close to the price, the short term, right? So I was I'm sorry for spelling out 20. Actually, in the process of making the video, I end up saying that. But yeah, it is 10 moving average. So now this one is a 20 period moving average. So what I want to tell you is that when there's slower moving averages, they are going to be more short term. Whereas they expand in time, they're going to be more and more medium term to long term in nature. Right. So whenever you see that as moving averages are coming close to each other, you will see that close to each other, you see there's an expansion of volatility starting from there. So an expansion of volatility starts there. So this is how you can use multiple moving average. Whenever you see them close to each other, there's an expansion of volatility starting. This is how you can use multiple moving averages. And if I just add the twin 200 period average, right? A 200 period average would be like this. Extremely sorry guys again that 2010 confusion. And yes, here we go. This is 200 moving average. So you see that the 200 moving average is really standing for the very medium term transition points and areas, the very long term important zones where the price has come, visited, revisited, revisited, right? So these are the important sorry, this one. Yeah, these are the important long-term highs and lows near about which the market is coming. And of course, just like when you see the expansion and contraction of volatility. Now, in this case scenario, we are seeing that the distance between the moving averages, whenever they are coming down, okay, whenever they are all close to each other, will be the places where there would be a maximum expansion starting from. So, maximum expansion of price movement starting from around these areas, you can see that. Around these areas, you can see that. So these are the things you need to take away from moving averages. Why the logic is, why this happens, knowing why this happens actually expands your understanding in a very different way. And I encourage students to ask me such questions. So in the comments, please ask me more questions. And when I encourage students to ask me, I explain all this to them. And in fact, in my course, I explain in further details. We give them many more examples and many more stocks and different understanding of moving averages. You can make unlimited permutation combinations. You can use different types of moving averages. Again, there's exponential moving average, right? The weighted moving average, etc. Also, you can use the moving averages in a sense that the different moving averages will be more proficient from one from another for different stocks. And when you're going to test them, sit and understand them, you will have to go through the details through some observation experience, and you are going to have to try and test different things which are happening. So these are very simple things I can explain the logic of from, and technical analysis is actually very simple. But the thing is that we are not trained our mind to understand things in a simple logical way when it comes to making money. So whenever it's about making money, we tend to think more capitalistic. But actually, if we think a little more creative, we can build the strategy which would be the best thing for the correct business model. And your trading runs on your business model. So if you understand that the business model you're using is consistent, is stable, is firm, is legitimate, then you are going to automatically be in a situation where you are going to see that all these legitimate business model creative ideas are going to come and yield you money almost effortlessly. So guys, work on your game and keep studying more and more about the different aspects of moving averages and about the different aspects of different technical analysis rules. This was a special nugget from my side, and there are many things which, when it comes to trading, a lot of people expect me to give calls, and I have done that for long. I will share the channel of my telegram channel link on the comment section. So I've done giving free calls, etc. And now I am more focusing on giving something to people which is going to benefit them for the long term than entertain them, than giving call in just trading some calls, which I also don't know how many people trade and how well they execute it. But yeah, so we've had nice times with giving calls, and now more on the YouTube space. So like the video, comment, share it with your friends, share it with your fellow traders who you would think are going to be benefiting from this. In my 9.5 years of experience with technical analysis, reading the best authors in the world, etc., and these learnings and assimilation of all the knowledge and things I have tested by myself. And these learnings, many of which you will not really easily find in some textbook, the kind of things I'm going to share now on, and the kind of things I've always been sharing with my students. Our students group is a community of a lot of my past students from the past 3.5 years, and all of them keep discussing new ideas, keep discussing stocks in question, etc. And the best part is they are always discussing on a common platform of understanding, since they've all done the course through me. So special nuggets all the time coming up. Eventually, I'm starting a new mini course apart from my flagship course on technical analysis, which I will update about soon, which is called the Indicator Factory. So I'm going to use my knowledge of all indicators and put it into one course. So Indicator Factory is coming up very soon. So thank you everyone. Have a great time to watch the video. Thank you for listening, and I will see you soon on another episode. Take care. Bye. Enjoy.